China's quest to get the yuan recognized as a reserve currency is fueling expectations that trading limits will be relaxed this year. What could this mean for the US dollar and gold? Joining me now is the best-selling author of Currency Wars, Jim Rickards. Thanks for being with us.
Thanks, Danielle. Great to be with you.
So, Jim, let's start with China's plan to make the yuan part of the IMF's basket of currencies. What could the ramifications be? I know you alluded to this in your first book, Currency Wars.
Right. This has been in the works for some time. Of course, the SDR is the special drawing right. That's what I call world money that the IMF prints, but it has a number of currencies behind it. It's not backed by anything. It is sort of pure fiat money, but the exchange value is calculated. So they're going to add the Chinese yuan to the basket. The immediate short-term ramification is that we have a sort of a peg between the dollar and the yuan. The currency wars are still being fought around the world, in Europe and Japan and elsewhere, but there's sort of a lull in the fighting between China and the US right now because the US has veto power at the IMF, so we're saying to the IMF, hey, if China wants to get into the yuan, the Chinese have to be on their best behavior. And we define best behavior as not cheapening the yuan. Their economy's slowing. Typically, their response would be cheapen the currency to stimulate the economy. They're not doing that right now. A lot of people short the yuan got caught out on that. So the short-term ramifications, the dollar-yuan peg is holding. I expect it will hold through the year.
And would this trickle down and affect gold?
Well, yes, because when you have that kind of stability between the dollar and the yuan, see, I think of gold as a currency.
Right.
And so when I hear the price of gold is down, I just say, well, the dollar's stronger, the price of gold is up. That means the dollar is weaker. But right now, we are in a strong dollar period, and the Chinese are not undercutting us, so the dollar may maintain that value.
China also expected to receive approval from its central bank for a yuan-denominated gold fix. Would this make the London fix less relevant?
Well, I think the London fix made the London fix less relevant, because of the manipulation, and this is not speculation, they were admitted wrongdoing there. So I think the London fix, it's now more automated, and I would say yes. Where is the gold market? Is it in London or in China? Well, for the time being, it's still in London, but because of the Shanghai Gold Exchange, because of the new standard, which is the old 400-ounce bar is kind of obsolete. It's the new 4.9 kilo bar that the Chinese have pioneered. So, the old saying, follow the money, well, follow the gold's going to China. So I would say, yes, that China has set up a rival for the London gold fix. But at the same time, China's trying to make nice. They've just joined the London gold fix through one of their financial institutions. So they have a foot in both camps.
Okay, let's look to Europe now. Greece expected to make a payment on June 30th. How do you see this story unfolding?
Well, I think it will unfold the way it has unfolded for the last 5 years, which is, look, a lot of turmoil. I'm not saying there aren't problems in Greece. Obviously, there are deep problems in Greece. But what I've said all along, going all the way back to 2010, Greece is not leaving the euro. There will be no Brexit. Nobody's getting kicked out. Nobody's quitting. Now, that doesn't mean that everything's fine in Greece. You could have bail-ins. You could have bank nationalizations. You could have bond defaults. There could be a lot of economic disruption around Greece. But none of that's the same as Greece leaving the euro. Greece is going to stay in the euro. But, you have to be careful around the Greek banks. But it does look like it's coming in for a soft landing.
But why are you so sure about that, Jim, that we won't see a Greek exit?
Because this is not primarily an economic issue. It's a political issue. This is what I call the Fourth Reich, which is Germany is, go back to 1991. Margaret Thatcher was bitterly opposed to German reunification because she said every time the Germans get together, they take over Europe. Well, they're doing it again, but they're doing it economically. So there's a political will to keep Greece in the euro. By the way, look at Greek polls. The Greek people overwhelmingly favor the euro. They don't like the austerity that goes with it, but the Greek people favor the euro. Germany wants them in the euro. The political will is there. They will stay, and everything else is just a detail.
All right, let's look at the US dollar now. I know in the past you've spoken about the demise of the dollar. The dollar has been on a rise since last June. Do you think it will correct here?
I think the dollar has to come down, and the reason I say that is because the strong dollar is killing the U.S. economy. This is part of the currency wars. I do talk about, in my book, The Death of Money, I do talk about the demise of the dollar, but the dollar is not going to fade without other currencies fading as well. This would happen in a global financial panic, but that may be a year or two away. In the meantime, you've got cross rates, and the thing about the currency wars is, 2011 we had the weak dollar, 2015 we had the strong dollar. I expect by 2016 you'll see a weaker dollar again. The reason is that the strong dollar is killing the U.S. economy. We're on the verge of a recession. Export sector is suffering. we're getting deflation. We're importing deflation from the rest of the world in the form of the strong dollar because it lowers the dollar price of our imports. That's deflationary. All of this is the opposite of what the Fed wants. The Fed wants more growth. They want more inflation, nominal growth and real growth. And the only way to get that in a world of too little growth is a cheap dollar.
All right, let's look at gold now, Jim. As we gear up for Q3, how do you see the metal set up, with many expecting a Fed rate hike to occur now?
Well, I'm not one of them. I think the Fed will not be able to raise rates in 2016. Of course, I said that in 2014. Here we are, almost July, and I'm sticking with that forecast. The data just doesn't support it. The data is too weak. So I see the Fed not raising rates this year. Maybe not till, actually I talked to one person I really respect, very plugged in individual. He doesn't expect a rate increase until 2017. I'm not quite there yet, but he may be right. So I don't see a rate increase on the horizon. That means a weaker dollar, which would mean stronger gold.
Okay, so for now you see gold sticking to this range?
Gold's in a range, but if the dollar is at the high end of the range and the dollar starts to come down, then the dollar price of gold should start to go up. I think of gold dollar as a cross rate. So strong dollar, weaker dollar price for gold. Weak dollar, higher dollar price for gold. So I am expecting the dollar to weaken. So I would expect the dollar price of gold to go up.
Jim Rickards, thanks so much for joining us.
Thanks, Daniela.
And thanks for watching. We'll see you on Thursday for the next Gold Report.